While the office vacancy rate in Toronto has pushed higher recently, our feature guest today says that if you look past Canada's largest city, there are some signs of strength for office properties. Joining us now to discuss, Colin Lynch, Managing Director and Head of Global Real Estate Investments at TD Asset Management. Colin, great to have you back on the program.
Thanks for having me. Great to be here again.
Looking forward to this discussion because we are going to move it outside the center of the universe, which of course is Toronto. But we do need to start with Toronto. It is the largest market. We are not seeing office properties rebound, perhaps as people had hoped. What is going on in Toronto?
Well, yeah, so we can start in the center of the universe as described. Toronto is an interesting market because Toronto has many portions to that market. We've got the downtown financial core. We've got Bloor Street, which is to the north. Further to the north, you've got St. Clair, Eglinton, North York Center, right? Just 5 or 6 nodes just along one street. Before you go further east or west along King Street East or King West, before you get to places like Scarborough Center, Mississauga Center, Vaughan. So lots going on. But you're right, the vacancy's up, but not uniformly, and different places are experiencing different things. One of the stronger places that we have seen has been around the Yonge and St. Clair node, as an example. Traditionally not the first place you look at office, but what you do see is great strength around that node. So you have really affluent communities, a lot of new things moving into that area, think restaurants, and a lot of vitality. You know, Bloor Street's been a little bit more challenged, and particularly the concourse that runs from Bloor and Yonge over to Bay and Yonge, but it really has been a building by building story on that street. Come further south into the financial core.
Yeah, where we're sitting right now.
Precisely. And I'd still say, so there's 2 pieces to that story. One piece has to be about quality. And like every period of economic dislocation, and I put what we are living through still into that bucket, even though we had COVID, which obviously was a big impact, nevertheless, there is a flight to quality. So if you're a tenant and you were in a Class B space, so a little bit older, a little bit less shiny and newer, a little bit less well transit connected, not as great from an environmental social governance perspective in terms of, call it energy efficiency, but you're paying this rent. And now you've got an opportunity to move into a brand new building with great amenities that's right connected to a subway station or Union Station here in Toronto. Guess what? You'll do that. And so we are seeing that, which is called the flight to quality. But that being said, there are still buildings, even in the downtown financial core, that don't fit that new generation, shining new building that's really well transit connected. And those buildings are struggling. And we are seeing vacancy rise significantly more in those buildings. So there is a flight to quality dynamic, and we see that in every economic period. We are, however, shifting from vacancy to actual physical occupancy, seeing tick-ups in physical occupancy. It's slow, but we have been seeing this since late 2021, and it's a steady and gradual sort of tick-up. Not so much on Tuesday, Wednesday, Thursdays in the core, because there we are not completely at normal, but we are sort of in the approximate range of normal. It's more on the Mondays that we're actually seeing a little bit of tick up there. So all to say, we are solidly in the hybrid work environment. I don't think we're moving from that. But the nature of that work in terms of the number of days in the office on average is still slowly adjusting. And that's the center of the universe.
By the center of the universe. My field of research, which simply means taking the train in every day, I did notice on a Monday morning, I was like, I'm not worrying about getting a seat. I'm going to get a seat. Today I was like, there's a few people on the platform. I'm still going to get a seat, but there's a few more people here. So that's Toronto. Mm-hmm. You've talked about the hybrid sort of work arrangement sort of taking hold. What about moving out of the big cities? We start going across the country. Is there still that reticence to return to the office, or are we seeing a bigger pickup?
Yeah, it's a really interesting question because a lot of times we tend to focus on Toronto or on Montreal or even on Ottawa. And of course, they're in our national consciousness. We think very heavily on those cities because they're large and big. We forget to realize that there are other cities. And cities like Winnipeg and Saskatoon and Regina. There are cities like Calgary and Edmonton. There are cities like Halifax and St. John's. And there, we are actually seeing a lot more pronounced return to the office. So in places like Regina and Saskatoon, most people are in the office between 4 and 5 days a week. In places like Winnipeg, it's close to 4 to 5 days a week. In places like Calgary and Edmonton, it's somewhere between 3 to 4 days a week on average. And so we measure these things on the basis of hours in the office per week, and the max is about 37.5, because allowing for half an hour every day for lunch out of a 40-hour work week.
What do you think is going on there? They like the coffee in the office, or like, well, why do they want to be in the office?
You know what? I'm tempted to think about the coffee, and I'm sure the
amenities,
coffee is
the
amazing. Yeah, the key thing is actually commute times. So the commute in a place like Saskatoon or Regina might be a 10-minute drive, whereas in Toronto, a 10-minute commute, for many people would get you maybe 5% of the way there to your office.
That'd be a dream. 10 minutes would be a dream.
Yes. So that's a very big driver. The smaller centers have better commutes in general, and so therefore the barriers to getting into the office are much lower in some of those smaller centers. What does that mean? More people in the office, and what we see from a vacancy perspective, a leasing perspective, and a general sentiment on the office is much more optimistic in some of those smaller centers than it is in the big, large centers like a Toronto or Ottawa, Montreal. In Vancouver, we still have a bit of hybrid for sure, but even there, for a different reason, we have a lot more people living amidst office towers. So a lot more people don't have materially large commutes in Vancouver, so we actually do see a bit more return to the office in Vancouver there as well.
All right, fascinating dynamics. This is also, if this year plays out, as the pundits have said, as the markets are betting, will be the year of rate cuts. Finally, that people have been waiting for that from the central banks. When they do, if they do come, what kind of effect could that have on office?
Oh, that's another great question. Certainly we expect that the rate cuts will generally be positive for office valuations. The question is, why are the rate cuts coming? Right? So if the rate cuts are coming because we have severe economic dislocation, that's generally, historically, not great for the office. Because again, office, like the other property types, serves the economy. So if there's less jobs and less people working at different companies, that's generally not good. There is a school of thought that says, however, if there's severe economic dislocation, folks will be more incentivized to come physically into the office.
Show the face.
So we've never seen that dynamic in the past, so it's hard to really quantify and measure that, but there is a very large school of thought that believes that that would be the case. But let's say hard landing is off the table and we have rate cuts because we are having generally a softer landing, which means whether it's tepid job growth or flat job growth. So if that is call it the scenario, then from a capital valuation perspective, certainly it's a positive for the office sector, like it is for the other sectors in real estate, and largely because, if we step back from that, investors into real estate have many things to choose to invest in, not just real estate. They can choose public stocks, and they look at things like dividend yields and earning yields, and they look at bonds, and they look at yields off bonds. So if rates are coming down, that almost makes the bar for competition for real estate lower, which means that for well-performing offices that are producing income and therefore cash flow, that becomes more attractive for investors looking for yield. So certain offices will perform much better. There will still be challenged office, regardless of whether rates come down by 100 basis points or 200 basis points. At the end of the day, if income is really low, then valuations will still be quite low because income's low. So you still need to look at what is the fundamentals of that office and what is the leasing in that office, what is the rental rates in those offices, and not to go into too much detail, but there's, call it gross or top line rents, and then there's the actual rent that tenants are paying because they tend to get incentives. And when you have economic dislocation, those incentives become larger and larger, which means that even though the top line rent is constant, the actual rent the landlord's receiving is going down. So you have to look at that dynamic as well. And for buildings that are challenged, that dynamic is a lot more present than for buildings that are less challenged. So even in a declining rate environment, it helps the office sector generally, but you really do have to look at what is the quality of the offices that you're investing in. It still matters.